So if I told you that General Motors sold about 13,000 fewer cars this quarter compared to the exact same time last year, you probably think that's bad news, right?
Oh, absolutely. I mean, in the old days of the auto industry, a drop in volume like that would just mean, a shrinking bottom line and panicking investors.
Right, massive pressure to just start discounting vehicles heavily just to get the metal off the lot.
Yeah, exactly.
But somehow GM took that contraction in volume and they turned it into almost $1 billion in extra profit, which is just wild to
That's a
me.
huge paradox, yeah.
And that is exactly the fundamental paradox that we are exploring today in this deep dive into the financial source material. So, welcome.
Thanks for having me.
So, for you listening, here is the mission today. We have the official General Motors first quarter 2026 earnings report sitting right here.
Heavy reading.
Very heavy. We've got the press release, the financial tables, the cash flow statements, the corporate guidance, all of it. And we are going to translate this really dense numerical document into a clear picture of how a legacy giant is actually surviving and profiting in this super chaotic era.
Yeah, and you really have to start with the top line numbers, I think, to establish that baseline reality right away.
Okay, lay it out for us.
So looking at the 3 months that ended, March 31st, 2026, their revenue came in at $43.6 billion.
Which is a drop, right?
It is, yeah, a slight contraction. It's down about 0.9% year over year. And then their wholesale vehicle sales, so, the units they actually moved to their dealers, those dropped from 912,000 down to 899,000.
So it's a clear mathematical reduction in their overall footprint.
Exactly. They are demonstrably smaller right now.
Right, but then when you move further down the income statement, you look at the EBIT adjusted line, which is earnings before interest and taxes, basically their core operating profit.
With all the one-time weird costs stripped out, yeah.
Right. That number jumped a whopping 21.9% to nearly $4.3 billion.
It's just a staggering jump.
It's like, okay, think about it like a restaurant, right? It's like a restaurant that served fewer tables on a Friday night, but somehow the owner took home 20% more cash at the end of the shift. Like, where is this extra money actually coming from?
Well, to understand the mechanics of that, you really have to look at GM North America.
Yeah.
That is undeniably the profit engine of this entire operation right now.
Okay.
Their EBIT-adjusted margins didn't just inch up. They climbed from 8.8% in the first quarter of 2025 to 10.1% in 2026.
Wow, 10.1%.
Yeah, and a 1.3 percentage point increase might sound small, but when you apply that to tens of billions in automotive revenue, it generates hundreds of millions in sheer profit. I mean, GM North America cleared almost $3.7 billion in profit alone.
Just in North America.
Just there.
Yeah.
And that tells you something fundamental about how they are running the factories today. They're no longer chasing market share at all costs.
So they're not just trying to be the biggest anymore.
No, the whole manufacturing strategy has fundamentally shifted. It's gone from pushing volume to really strictly protecting pricing.
Because in previous decades, the standard was just to, like, overproduce.
Oh, totally. Flood the dealer lots and then offer those massive cash-on-the-hood incentives to force the inventory out.
Oh.
But what the Q1 data shows is this highly disciplined constraint of supply.
They're holding the line on pricing.
Exactly, and heavily prioritizing higher trim models. I mean, think about it. A base model vehicle and, say, a fully loaded Denali or a Cadillac, they share the same underlying platform.
Right. The same chassis.
Same chassis, roughly the exact same assembly time in the factory. But the profit margin on the premium trim is just exponentially higher.
So by prioritizing those high-end vehicles, they're extracting maximum value per unit.
Right. They are very comfortable selling less metal as long as the metal they do sell is highly, highly profitable.
Which is a massive philosophical shift. I mean, it clearly gave management a lot of confidence because one of the biggest highlights in this report is that GM actually raised their full year 2026 guidance.
Yeah, they bumped their expected EBIT adjusted range up to somewhere between $13.5 billion and $15.5 billion for the year.
And this is where it gets kind of funny when you read the press release to find out why they're so optimistic. It has literally nothing to do with consumer demand.
Right. It's not a new truck.
It's not an innovative new platform or incredible sales forecasts. The press release explicitly states that this bump is largely due to a favorable adjustment of approximately $500 million coming from a U.S. Supreme Court decision.
Yeah. The lawyers earned their paychecks this quarter.
for sure. But wait, what is that ruling actually about?
So it specifically addresses certain U.S. tariffs that GM had to pay under the International Emergency Economic Powers Act.
Hmm.
And winning this drops their expected gross tariff costs for the 2026 calendar year down to a range of $2.5 billion to $3.5 billion. So that effectively saves them the roughly $500 million that we are now seeing baked into this brand new upgraded forecast.
Okay, I have to push back on the framing of this as a strategic win, though. I mean, you can't engineer a lawsuit the way you engineer a chassis.
No, you definitely can't.
Right. Like, if I'm looking at this as an observer trying to gauge the long-term health of an automaker, a $500 million administrative windfall is fantastic for this quarter's balance sheet, obviously. But isn't it essentially a lottery ticket?
It is a one-time structural relief, yeah.
Right. So building a rosy financial forecast on the back of a Supreme Court ruling feels like a massive vulnerability to me. Is that really a sustainable business model?
Well, no, and I think that vulnerability is exactly what this particular line item exposes.
Yeah.
It gives you this glaring look at the macro reality of global automotive manufacturing right now.
How so?
Well, we are talking about a company that, even after this massive Supreme Court victory, still expects to pay up to $3.5 billion in gross tariff costs this year.
Wow. Just in tariffs.
Just tariffs. That is $3.5 billion of pure friction cost just for doing international business, completely separate from the actual costs of labor or materials or R&D.
That's crazy.
So while the guidance bump makes for a really great headline to appease the shareholders, the underlying reality is that geopolitical and legal factors have just as much immediate impact on their bottom line as operational efficiency.
Sometimes more impact.
Yeah, often more.
Which naturally brings us to where GM is aggressively spending the cash that they're making from those high North American margins and these legal windfalls.
The cash flow statement.
Yes. If you want to see the actual friction of transitioning an automotive giant, you have to look at the cash flow statement. And the numbers here present a really massive structural disconnect.
They really do.
Like their automotive operating cash flow, which is the actual cash generated from their core business of making and selling cars, just plummeted. It dropped from $2.4 billion in Q1 of 2025 down to just $533 million in Q1 of 2026.
That is an almost 78% drop.
Right. But then, literally the very next line item, adjusted automotive free cash flow, went up by 56.4% to $1.27 billion.
Which looks like a typo if you don't know what you're looking at.
Exactly. It's like looking at your personal bank statement and completely panicking at a huge drop in your funds until you remember, oh, wait, I just paid a contractor to renovate my kitchen. It's an investment, not a daily expense.
That's a good way to look at it.
But the question is, are they just renovating the house or are they tearing it down to the studs? Because to reconcile those numbers, you have to look at the adjustments table.
Right, which isolates the non-recurring events that management basically says are distorting the core operating picture.
And there is a staggering $2.23 billion adjustment listed for EV strategic realignment. And that same realignment hit their EBIT adjustments for over $1 billion, too.
The scale of that is just wild.
It is. When you see strategic realignment in corporate speak, especially attached to a $2.2 billion price tag, that means the previous strategy was a failure, right? Like, it requires a massively expensive course correction.
Yeah, it's like trying to change the engines on a 747 while it's still in the air.
Exactly. The highly profitable internal combustion engine business in North America is providing all the lift right now, but they are spending billions mid-flight to swap the propulsion system over to EVs before they lose altitude.
But taking a hit of that size in a single quarter means this isn't just a minor tweak to their battery chemistry.
No. What does a physical realignment of that magnitude actually look like on the ground?
It involves halting factory construction, breaking supplier contracts, retooling assembly lines that were meant for electric vehicles, and pivoting them back to internal combustion or hybrids.
Just eating the sunk costs.
Yeah, absorbing the sunk costs of totally canceled vehicle programs. I mean, the press release maintains their commitment to an, quote, all-electric future.
Right, they have to say that.
Sure. But the financial reality of a $2.23 billion charge tells you that the initial EV roadmap they drew up a few years ago just met a brutal reality check in the actual consumer market.
People weren't buying them the way they projected.
Exactly. They're paying billions of dollars today just to undo the footprint of their previous assumptions, just so they can attempt a more pragmatic transition tomorrow.
It's just a massive financial bleed required to stabilize the strategy. And, speaking of brutal reality checks, that brings us to their international
Yeah,
strategy.
China.
Because North American margin efficiency only works because GM basically owns those factories outright. They control the supply chain. But when you look at China, which is the world's biggest auto market, GM operates under an entirely different, heavily restricted structure.
And the numbers there reflect a really fascinating survival tactic right now.
Okay, let's start with the volume drop.
The volume contraction in China is severe. Their total vehicle sales plummeted from 443,000 in Q1 of last year down to 349,000 this quarter.
That is a huge drop.
It is, and consequently, their market share in the region dropped from 7.6% down to 6.9%.
Okay, but here is the data point that demands an explanation. Because despite those plunging sales and a shrinking slice of the overall pie, GM's China equity income soared. It went from $45 million up to $165 million.
Yeah.
They lost nearly 100,000 vehicle sales, but somehow they almost quadrupled their income. If your market share is shrinking and your sales are plunging in your biggest international market, how do you mathematically quadruple the money you're taking home? Are they just cutting costs to the bone?
Well, the answer lies in how that money is legally structured over there. GM doesn't consolidate the total revenue from China onto its own top line because they don't actually operate independently there.
Right, the government requires joint ventures.
Exactly. They operate through massive joint ventures.
Yeah.
Specifically, SAI General Motors Sales and SAIC GM Willing Automobile.
Got it.
Because they are a minority or just an equal partner, GM only reports equity income, which is simply their percentage cut of the joint venture's final bottom line profit.
Okay, so how did that profit spike so high?
Buried in the supplemental material of this earnings report, there is a $78 million adjustment for, quote, China restructuring actions.
Ah, so they really are stripping the operation down to the studs.
Yes. Facing this hyper-competitive, deeply subsidized domestic EV market in China right now, GM is clearly abandoning any hope of dominating market share.
It's just too crowded.
Way too crowded. So instead, they are forcing these joint ventures to enact ruthless austerity measures.
Like what? Shedding unprofitable models.
Shedding models, likely slashing marketing budgets, definitely cutting headcount. The overall joint venture is generating far less revenue, but by cutting the overhead to the bone, the actual profit margin on the remaining sales is artificially higher.
Wow. So GM's specific cut of that profit, the equity income, just spikes up.
Exactly. It is a purely defensive maneuver designed for immediate cash extraction. By leaning out the joint ventures, they maximize their short-term yield.
But taking this approach in the world's largest automotive market obviously sacrifices future scale. I mean, you cannot cut your way to long-term growth.
No, you can't. Driving up equity income through restructuring actions is a very finite strategy.
Because eventually you just run out of overhead to cut.
Right. And then you are left with a vastly diminished footprint in a market that will dictate the future of global automotive scale.
Which is a scary thought for them, I'm sure. And this brings us to the final crucial piece of this whole puzzle.
The fleet sales.
Yes. We've established that GM is relying on disciplined, constrained supply in North America to maintain that incredible 10.1% margin. But auto manufacturing is fundamentally a game of fixed costs.
Huge fixed costs.
You have massive factories, union labor contracts, billions in equipment. If consumer retail demand softens even slightly, like because of high interest rates or inflation or just a natural economic cycle, you cannot just turn off an assembly line.
No, the fixed costs will bankrupt you if the line stops moving.
Exactly. So how does GM maintain the volume required to keep those factories running efficiently without flooding the retail market and destroying those premium prices we talked about?
You look at the fleet sales. This is really the auto industry's ultimate pressure relief valve.
Give us the numbers for Q1.
In Q1 of 2026, GM's fleet sales rose to 266,000 vehicles.
And just to clarify for you listening, these are bulk transactions. We're talking about sales to rental car companies, commercial businesses, government agencies.
Right. It's like the corporate catering gigs of the restaurant world.
That's a perfect analogy. It's not as glamorous as a packed dining room paying top dollar for steaks, but it guarantees volume and it pays the utility bills.
Totally. And the key metric here is the concentration of those sales. Fleet sales now account for 20.6% of GM's total vehicle sales globally.
Over 20%.
Yeah, and that is up from 16.5% just a year ago. More than 1 in 5 vehicles rolling off a GM assembly line right now is going to a fleet buyer.
And the earnings report is very transparent about the financial reality of these transactions. They note explicitly that fleet sales to rental companies are, quote, generally less profitable than retail sales to end customers.
Which creates a really complex dynamic for their margin strategy. I mean, fleet sales provide guaranteed volume. They ensure the stamping presses keep moving and the supply chain remains active.
Which absorbs all that massive fixed overhead of the factories.
Right. By dumping excess capacity into rental fleets, GM actually protects the retail side of the business.
Oh, because the local dealership doesn't have 50 extra cars sitting on the lot, forcing them to offer aggressive discounts.
Exactly.
It subsidizes the illusion of scarcity for the everyday consumer. The retail customer pays top dollar because supply looks tight on the lot, while the factory maintains its required output by quietly moving tens of thousands of units at a discount to rental agencies.
It's a delicate balancing act, though, because there is a tipping point.
Well, yeah, if over 20% of your business is now flowing through a much less profitable channel, that 10.1% North American profit margin is going to come under serious pressure eventually.
Definitely. You cannot rely on low-margin volume to protect high-margin retail forever, especially if the retail consumer starts really pushing back on those premium prices.
Right.
The reliance on fleet volume is often a leading indicator of underlying retail softness. When that percentage climbs from 16% to nearly 21% in a single year, it signals that the consumer market is no longer naturally absorbing the output of the factories.
It is a necessary buffer for today, but it dilutes the overall profitability the heavier they lean on it.
Exactly.
Okay, so when you pull all of these disparate threads together, the margins, the tariffs, the EVs, China, the fleets, the narrative that emerges from this Q1 report is fascinating, and it stands in stark contrast to the traditional PR talking points of the auto industry.
It really does.
I mean, the front page of the press release paints a picture of a company confidently marching toward this advanced all-electric future. But when you look at the mechanics of how they actually generated $4.3 billion in operating profit this quarter, the reality is entirely different.
Yeah, because the profit isn't coming from electric innovation.
No.
It is coming from a highly disciplined extraction of value from their legacy combustion engine business.
They are artificially constraining retail supply in North America to force consumers into high-margin trims.
And they are aggressively shrinking their footprint in China just to pull forward a temporary spike in equity income.
Plus, relying on commercial fleet sales to absorb the excess capacity that retail consumers can no longer afford.
While taking massive multi-billion-dollar write-downs just to fix the mistakes of their initial electric vehicle strategy.
Not to mention relying on a $500 million Supreme Court tariff ruling to prop up their annual financial guidance.
Right, the lawyers again.
Right. Looking at all of this, it feels like the narrative of the EV revolution is being entirely subsidized by the very things they are actively trying to phase out.
Combustion engines, fleet sales, ruthless joint venture restructuring, and legal loopholes.
Yes. The legacy business is working overtime just to pay for the course correction of the future business.
And I think that forces you to reconsider the timeline of this entire industry transition.
How so?
Well, think about it. The report states GM is driving toward an all-electric future. But if a legacy automaker's most impressive financial gains are currently derived from administrative wins and just squeezing the final drops of efficiency out of an old operational model, rather than from explosive consumer demand for their new EV technology, it really reveals how fragile the electric transition actually is.
That's a great point.
The capital required to fund this evolution is so immense that they cannot afford for the old business to falter even slightly. So it leaves you wondering, are we actually witnessing a rapid consumer-driven leap into the future, or is this just a heavily subsidized delay?
We are watching a legacy giant desperately trying to keep the plane in the air while tearing the engines apart mid-flight. It requires a staggering amount of capital, a lot of defensive maneuvering, and more than a little luck in the courtroom. Well, thank you for joining us for this deep dive into the financial source material. For you listening, the next time you see an automaker boasting about record profits and a seamless transition to the future, remember to look past the top line. Check the cash flow adjustments, look at the fleet percentages, and ask yourself what is actually funding the revolution.